Tell me if you heard this one before. There's a global pandemic, hundreds of thousands of Americans die, millions globally. Businesses fail at record rates, tons of people are out of a job, stock market crashes, and then for some odd reason, like the phoenix rising from the ashes, you have the stock market come back and you have one of the greatest economic booms in history. Sounds familiar, right? Well, this was the crazy years. This was the honest fools. This was the roaring 1920s. And what I'm going to do in this video is talk about the things that we see that could potentially set up the next roaring 20s, the roaring 2020s. The COVID-19 recession led to the quickest and the strongest monetary and fiscal response from the US in history. Now, in relation to the great financial crisis of 2008, and as a percentage of GDP, the COVID-19 recession response was 2.5 times greater. And then globally, by June 2020, $10 trillion of stimulus had been injected into the system. Now that's a lot of stimulus to boost growth now and boost growth well into the future. And now with the new administration, with Biden's administration, we have his first economic stimulus plan of $1.9 trillion. And they're still working on a new infrastructure and other stimulus plans to help boost growth. And then really most importantly, the Fed funds rate is all the way back down to zero. Now all the stimulus, the monetary and fiscal policies, it really helps stave off an economic malaise. But now as the US gets vaccinated, as the rest of the world gets vaccinated, this stimulus in the system is really setting up the economies for some booming growth. In our view, a booming economy is going to be centered on 5 main things: employment, GDP growth, corporate earnings, the financial markets, and the fiscal health of the US consumer. Talking about employment first, between February 2020 and March 2020, the US lost 22.4 million jobs. Unemployment rate spiked up to about 14.8%. Now, this is a level not seen since the Great Depression, and this is 50% higher than the unemployment rate during the Great Financial Crisis. Now, since March 2020, the US has gained 12.9 million jobs as of the time that we wrote this letter. The unemployment rate's dropped back down to 6.2%, and if these trends continue, we may see 4.2% unemployment by the end of the year, and then 3.5% by 2022. These are pre-pandemic levels. And then similar to employment, Q1 and Q2 US GDP just fell off a cliff. In Q1, GDP dropped 5%, and then in Q2, it dropped 33%. Then in Q3, GDP rebounded, it went up 33%, and Q4 was up 4.2%. So for all of 2020, GDP declined 3.5%. This is a correction we haven't seen since World War II. Now in March 2021, the US Federal Reserve has upped their estimate. For 2021, they think we're going to have about 6.5% GDP growth, and then 3.3% for 2022. Now both of this is well above the long-term 2% GDP growth the US has been experiencing. Corporate earnings in 2020 dropped 22%. Now the estimates for 2021 is a rebound of about 40%. During the coronavirus market panic, the US stock market experienced one of its quickest and deepest corrections. And things were going so bad that some people were actually calling for the market to close. They just couldn't take the pain anymore. But lucky for them, the market didn't close. And probably one of the sure signs that the US stock market is very forward-looking, 3 weeks into the pandemic, the US stock market started to recover and rebound. And by August 2020, the US stock market, the S&P 500, had hit a new all-time high. Again, the monetary and fiscal policy helped arrest that stock market slide. It allowed investors to realize that the S&P 500 and the public markets in general are made up of just the largest companies. Even the small cap companies are very large. And they were able to survive and thrive in this environment. Small private businesses, not so much. For example, take Starbucks. They had the drive-thrus, or they had a lot of stores with that. They can handle reduced contact delivery and people still get their coffee from them. Now you compare that to your local corner cafe that was in the business district, relying on people and their foot traffic to come in. They weren't going to survive this. And because these large companies were able to adjust how they operated in coronavirus lockdowns and they had the resources to survive, now that we're facing opening up and people are getting vaccinated, they're in an even better position to win market share and to have a booming business. Now, one thing we didn't talk about in our letter to clients was just the overall health of the US consumer. These next couple of charts, I found them in the Wedgwood Investors client letter. I'll put a link to that down in the description. And the first chart from the letter is this one from DoubleLine. and it's the ratio of personal savings as a percentage of disposable income. The stimulus money, and then not being able to go out and spend excess money has really led to this high savings rate. It's led to this pent-up demand. And the second chart, which is originally from JP Morgan, it kind of shows the same thing. It just shows that the US consumer as a whole is just flush with a lot of cash in their bank accounts, ready to find some avenue to be spent on. This is not to say that nothing could go wrong. If you know us, if you know American Money Management, we're always looking to what is the risk? What is the potential downside here? But the first big risk we have to worry about is inflation. And as the economist Milton Friedman said, inflation is always and everywhere a monetary phenomenon, in the sense that it is and can be produced only by a more rapid increase in a quantity of money than in output. Inflation has been low for many years, and for some countries it's been stubbornly low. They've been worried about deflation. You can make the argument that demographics, high debt levels, gain in productivity have helped keep inflation low. But now what happens with all the stimulus in the system? We've already seen the M2 money supply have one of the biggest increases it's had year over year. You're starting to see input costs rise for businesses. Just take a look at lumber. And then you're also starting to see some labor shortage, which can help push input prices up. Now, the consensus view is these inflationary measurements are transitory. Supply chains have been stretched, so once they get back to normal levels, then these input prices will come back down as well too. But inflation's hard to predict. We think we know it, but we really don't. We don't know when it's going to rear its ugly head. So with all the stimulus in the system, and with a lot of developed worlds having a high debt load, if we get high inflation and you have these high debt loads, that we potentially have a recipe for stagflation, just like we did during the 70s. And that was a poor period for wealth creation. The next risk is just high asset values. On pretty much most valuation metrics, the S&P 500 is well above its historical averages. One of our mantras is the price you pay determines your return. Pay too high a price, with everything else being equal, the lower your return going forward. It's the old buy low, sell high. Now, this math and the concept is pretty straightforward, but the psychology around it, not so much. When we have periods of strong stock market returns, it tends to lead to the recency bias. This is when people take current high returns and they extrapolate it well into the future. They think they're going to get the same returns going forward. But if history is any guide, you need to temper those expectations. And if the Roaring Twenties is the consensus view, now this is not just our original idea, we have seen it other places, then asset prices have tend to move in positively anticipation of that economic boom. And then when you have high asset prices, high valuations, you tend to have poor stock market returns after that. Just look at the periods after the bubble years of the late 1960s and late 1990s. The next risk is debt. When you just kind of look at it from the household perspective, a high debt load really crimps your future growth. Now, more of your budget has to go to servicing that debt. Now that's kind of just a simplistic view. When you're a country, say a developed country, and you're the US and you have reserve currency, the situation is a little bit more complicated. But you still have to service that debt. And right now, the US debt to GDP is 107% versus 80% pre-pandemic levels. Now, will this high debt load hinder our future growth? Or will the investment into our economy help spur growth? And will that growth, that growing GDP, help lower our debt ratio going forward? And just like the original Roaring Twenties, we're seeing the increased signs of speculation. This chart is the level of margin debt versus the Wilshire 5000. The two are highly correlated, and current levels are near all-time highs. Now, this doesn't predict a crash, but it's just one more piece of evidence that prices are high and risky behavior is well entrenched. Given those risks, we're still rooting, obviously, for a full recovery. And what we would hopefully have is kind of a range-bound market at worst to help reduce some of this excess in the system so that we don't see a speculative-induced bust. Now, for where we're finding value in a market showing signs of excess, you can learn about that by downloading our original client letter. There's a link down in the description. And if you want to watch a video about one of our previous quarterly letters, you can watch this one. And if you happen to see that, watch this video. And if you enjoy this video, please hit subscribe.